This big box retailer has all the makings of a great American success story. Starting out in 1962 as a humble discount retailer in Minnesota, Target rapidly expanded across the American heartland. Their focus on upscale discount retailing set them apart from discount competitors like Walmart. Target captures the more affluent suburban millennial cohort with discount prices on discretionary home goods. But this cohort is disappearing as Target's sales have suffered in recent years, and with Target's latest earnings, things seem to be getting worse. Welcome to The Quality Investor. The Target concept proved effective. By 1975, there were 49 stores in 9 states, and by 1980, 167 stores existed. And by the early 90s, Target had reached 912 stores. By 2018, Target had finally opened a store in each U.S. state, with the South Burlington, Vermont location filling the map. During this span of existence, Target had reached over $72 billion in revenue annually and joined the anointed and exclusive club of dividend kings. Target has grown its dividend now for an astonishing 57 years. This has made Target a favorite stock to own for dividend investors, which routinely makes top dividend stock to own lists on various social media platforms. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. But in recent years, the results Target has delivered have been underwhelming. Their 3-year CAGR for revenue is 0.2%. On a 1-year basis, they've declined by 0.8%. For the 3-year CAGR, contrast that to Walmart's 5.9% growth and Costco's 6.6% growth. And if you look at Target's fundamentals, it is the opposite of what you want to see from a potential investment. I'm always fond of showing what a company's fundamental charts look like because I think it perfectly demonstrates the quality versus a bad quality business. And Target is a bad quality business, at least it has been for the last few years. When you see a Visa or a MasterCard or a Microsoft, it's just a picture of perfection, everything is going up. But with Target, we can see everything is either flat or trending in the wrong direction. Revenue did peak a little bit here in 2022, kind of a post-COVID bump, but has just been declining ever since. The same can be said for gross profit and operating income as well. You can see on a 3-year basis, gross profit is down 1.06% annually, and operating income is down 14.63% annually. But the real things I want to point out here are the free cash flow and the dividend. Target was never a massive free cash flow compounder like we see with some of these tech businesses, but that free cash flow has been seriously falling off a cliff in the last few years. It was negative in 2023, sort of climbed back up a little bit, but is now down again on a trailing 12 basis. They've only generated $3 billion in free cash flow on a trailing 12 basis, down from the full fiscal year 2025 year of $4.47 billion. And when we have a declining free cash flow like this, that puts into jeopardy everything else that a business wants to do. Look at the dividend. The dividend has become stagnant, barely growing. It only grew 1.8% in the last 1 year. The shares outstanding. Target would buy back a lot of shares. That is ground to a halt as well. And you'd think at a price of $86.32 that this would be good to repurchase shares. But declining free cash flow puts a lot of those capital allocation decisions into jeopardy. And when you have declining revenue, that ultimately is going to hurt the margins, which are a primary driver of value creation for investors. Increasing margins, expanding margins, drive value creation for businesses. And we can see that gross margin has steadily decreased over the last 10 years. The same is true of the operating margin, and the same is true of free cash flow margin. And when you're earning less income than you were earning before, that's also going to hurt your ROIC. We can see the ROIC has been declining as well. So there's nothing here about Target that screams this is an undervalued or underappreciated play in the market right now. It seems that the market is appropriately giving Target a shrinking multiple because they're just not performing the way they used to. So what's going on with Target? Why had they been declining while their major competitors, Walmart, Costco, and Amazon, have all been flourishing? I want to give my thesis as to why Target is declining and why they'll keep falling behind, as well as what their earnings were this most recent quarter and what a reasonable price for Target's stock should be, if you are the type to risk a risky turnaround play. But first, Target's share price. Target trades at $83.68. If you bought Target stock 10 years ago, your annual return would be 1.7%. In fact, you would have lost money when factoring in inflation. 5 years ago, you've just lost 13.5% annually. Target is now down 38.1% year to date. This decline has lasted years now. Because of that, waving away Target's performance due to a shaky consumer environment is not good enough. More is going on than just economic uncertainty. Remember, Walmart has returned 16.3% annually the last 5 years and is up 18.6% year to date. My thesis for Target's decline is simple. They are getting crushed in the new frontier of retailing, e-commerce. And they are getting crushed because they were slow to adapt to a new paradigm. Target was actually strategically early to online retailing because they partnered with Amazon in the 2000s, allowing them to handle operations and fulfillment. But as most partnerships do, in 2011, it came to an end. That meant Target had to build its e-commerce platform from the ground up. This took years of investment to build expertise in logistics, digital marketing, and online platforms. Meanwhile, Walmart had begun investing in its own e-commerce business since the 2000s, allowing them to scale much earlier than Target. While all of this was happening, Amazon was building the largest third-party seller platform in the US. While no competitor is coming close to Amazon Marketplace in the United States, Walmart has successfully built a robust platform of their own. Walmart's Marketplace has attracted over 200,000 sellers. The Target Plus platform has managed to gain only 1,325 sellers. It is also invite only for some reason, which would severely limit its reach. Amazon, by the way, has about 1.9 million active sellers on their platform. This is all important because a robust marketplace benefits from the network effect. More users create more value. Target is falling behind here too. This article really sums up why Target is getting crushed. How Target lost to Walmart in the online shopping wars. Target and Walmart are among the largest department stores in the US, but the latter has surged ahead in the big box competition. Target's troubles are the result of years of missteps, from overstocking on home-centric items during the pandemic to walking back its diversity, equity, and inclusion initiatives earlier this year. Now, to be honest, I don't think the DEI stuff is playing too much into Target's misfortunes here. This has been a business that has been declining for years, and boycotts rarely, if ever, play a central role in a business's decline. In contrast, Walmart has better positioned itself over the last decade to compete with places people shop online. That's crucial considering e-commerce sales are growing faster than in-store sales, even though more money is still being spent in physical retail stores. And this chart here really shows how Target is struggling. Target forecasted to rake in less than Amazon, Walmart, and e-commerce. And it's more than that. They're forecasted to bring in less than Apple, eBay, Temu, and even Home Depot. What this chart shows is how minuscule Target's market share is in the e-commerce world. Walmart can essentially get to 95% of the country in 3 hours or less and sell the product to the consumer at the same price as you would pay if you were in their stores. And that's an important point. There's Walmarts everywhere. Target does not have nearly the footprint that Walmart has. So same-day delivery, that convenience that customers look for, is simply not there with Target. The digital divide has grown between the two retailers. Walmart's global e-commerce business grew by 25% in its fiscal second quarter, while Target's comparable digital sales only grew by 4.3%. So not only are they already way behind in the e-commerce market, they're losing market share. And they show these numbers here. So although Amazon leads in e-commerce with 40% of sales, Walmart comes in second with 9.4%, and Target only accounts for 1.6%. And again, that percentage is going down the slower they grow that business. And this also comes down to a fundamental difference in Walmart and Target's businesses. Walmart excels in everyday essentials such as groceries and other household must-haves, the types of product people are likely to order with the press of a button on a regular basis. They're killing it in online grocery, and that's actually made Amazon, for one, sit up and notice. Target, meanwhile, has a bigger focus on discretionary merchandise, like those offered through its private label brands across apparel, accessories, and other categories. That's a challenge for Target at a time when consumers are concerned about grocery costs and skipping discretionary purchases. The other issue with discretionary purchases is it doesn't lead to a lot of repeat buying. Essential items people need to buy over and over again. Target's not providing that type of value. So these woes have been compounding for Target, and their financial results, they've been bearing this out now for quite some time. This third quarter earnings report was yet another brutal blow for the business in 2025. Sales were down 1.5% year over year to $25.3 billion, which actually beat estimates depending on which estimate you use. Earnings per share also declined 3.9% year over year to $1.78. That also beat estimates actually of $1.73. But neither of these moved the needle because the real metrics for the bricks and mortar retailer are even worse. Comparable store sales, a massive retail metric, was down 2.7% year over year. And that's just for the quarter. Year to date, comp sales are down 2.8%. This decline is driven by less store traffic. And for people that do shop there, they're spending even less money. For the quarter, the number of transactions is down 2.2%, and for the year, it is down 1.9%. An average ticket, or how much money that's spent per transaction, that's down 0.5% on the quarter and 0.9% year to date. Target is hemorrhaging customers. This also speaks to Target's poor value proposition. Target's core is their in-store experience. They tried to replicate their discretionary heavy product offering online with apparel and home decor. While that works for in-store treasure hunting, it translates poorly to an online model where consumers prioritize essentials and repeat purchases. So on one end, Target is getting squeezed by Walmart on essentials, and on the other end, Amazon is squeezing them on speed and convenience. This is why Target is bleeding shoppers. Target was slow to adapt to the e-commerce environment, and this has now led to losses on in-store value. As I showed earlier, this has impacted their margins and free cash flow as well. All of the financial markers of the business are trending in the wrong direction. So with that, what is a reasonable price for this stock? Is it even worth investing in? Or should we wait until they prove they can turn this ship around? Let's find out what the valuation summary says. Those who've watched my channel for a while know that I regularly scold Target. I like to use them as an example of what a not quality business is. I also think it's an interesting case in potential dividend cuts down the line. Remember, I talked about that free cash flow declining. We'll see if they can maintain dividend growth here over the next few years. Now that said, this is the revenue projections I have for Target over the next 10 years. On a bear case, I have that revenue growing at about 0.7% annually, up to 2.5% on the bull case. Not very good here. And my year one estimate for revenue is at $104.7 billion, which would be a decline of nearly 1.8%. The operating margin keeps shrinking as well. It's something we don't like to see in our businesses. Trailing 12 basis, it's at 4.9%. I have that operating margin at 4% by year 10 for the bear case, up to 6% for the bull case. A 6% operating margin would be in line with what they were historically before the COVID pandemic. And for free cash flow, that margin I also have shrinking on the bear case. It's at 2.86% on the trailing 12 basis here. I have that at 2.07% by year 10 for the bear, up to 3.7% for the bull case. And we can see here on that trailing 12 basis, that free cash flow has contracted considerably, down 33.8%. And for year one, I'm estimating it to be down about 38.5%. And by the way, that free cash flow margin on the bear case, that means they're going to contract their free cash flow by 2.3% annually, but grow it at 5.3% annually for the bull case. Target is trading at $87.58 right now. It gives us a PE ratio of 10.6, well below their 5 and 10-year average, and I think given their growth trajectory over the next few years, they should have a shrinking multiple. Their forward PE is at 10.9, also far below their 5 and 10-year average. And if we took that $87 in the market today and applied a reverse DCF, the market is expecting free cash flow growth for Target at about 0.5% per year over the next 10 years. My base case has that at 1.65%. My bear DCF price for Target is at $63.66. I have a $95.72 base case DCF. And on the bull case, $136.33. So even if they have very minuscule revenue growth of about 2.5% and simply expanding that margin by about 1% from where it is today, there is upside here for Target. So if they can actually turn this around, right now they're trading at some good value. The question is, can they actually turn it around? Can they catch up to Walmart and Amazon? And I'm not even catch them, but just play in the same vicinity as what they're playing in right now. Like I said, Target pays that dividend. It's at $4.52 right now. On the bear case, I have it growing at 1% annually, up to 4% annually for the bull case. But could that dividend be cut? Right now, they have a free cash flow payout ratio of nearly 70%, which is quite high. So if they don't start generating more free cash flow, we could see a cut to that dividend. That said, my dividend discount price for the bear case is at $61.15, $77.49 for the base case, and $106.07 for the bull case. Without any margin of safety, we have a buy price for Target at $91.80. But I like a 30% margin of safety for Target, which would put them at $64.26 or a forward PE of 8. Now, to be completely honest, I have zero plans to add Target to my portfolio. I don't care if they come down to $45.90 per share. Every metric is trending in the wrong direction for Target at this point. And it's hard to see how they're even going to grow their way out of this if they're already hemorrhaging traffic at their current stores and they can't seem to get their e-commerce side of the business right at all. For me to even consider Target, it would be years of proving that they're growing their e-commerce business, that they're growing their store traffic, that they're recapturing the consumer cohort that they've been losing. And that will take years of turnaround for this business that right now shows no evidence of doing so. So if you want that risk and you think this is a good turnaround play, again, they haven't shown anything that they're actually going to turn it around, then a 30% margin of safety would put them at $64.26. Personally, I believe Target is a business to absolutely avoid in your portfolio. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.